years, if you're lucky enough to be in a family where you don't have, where your parents are taking care of your financial obligations, every dollar then is, worth making 10 or $20 later on. And so if you are interested in financial matters, getting a stake early is very useful, and getting knowledge early is very useful. So
Wait, but Warren Buffett, the number one considered stock investor in the world, what if I don't have any knowledge of these financial stock obligations? Well, I might just have the answer for you. Today, I will be testing out 5 stock investing methods that require no knowledge nor any investing experience except only knowing the steps of these simple techniques. But first, we gotta go over Stock Investing 101. Hello there. My name is Aiden Mo, and I will be testing out 5 stock investing methods that require no knowledge nor any investing experience, except only knowing the steps of these simple techniques. But first, we gotta go through Stock Investing 101. Stocks, the cornerstones of the very businesses and corporations that operate to this day, like the well-renowned names of Amazon, Nvidia, Microsoft, Apple, Target, you name it. Across news outlets, these prices of company shares are covered 24/7 towards stockholders literally salivating at the trend of their portfolios rise or fall. Several consumers all over the world having different ranges of wealth intend to invest a couple $100s to millions into their favorite organizations. This works when investors buy a percentage of a company's ownership, basically your share, that essentially gambles with the chances that company grows with your investment or falls. Companies can utilize your investment for building more capital and expanding their business, or focusing on marketing, making up for debt, etc. There are pretty much 2 reasons people invest. One can be that people favor the success of one company by investing in it, and this can be because they find interest in the company's mission, they believe their innovations can be very beneficial, or the company's sustainability. Though most investors do not bring this mindset when investing, bringing me to my second reason, that people desire financial profit. From building retirement revenue, making conveniently short-term money profit, or generally building up wealth. How about investors like me, who have no idea nor any experience how to measure the market, but want to make money without a whole lot of effort? That's where this study comes in. Our investigation will answer the research question, what can be an effective and reliable way to profit off stocks without having any prior investing experience? In this experiment, I will be testing out 5 investing strategies that don't require any investment knowledge at all. The investment experiment conditions will include the following. 1. There will be strictly 5 test trials per investing strategy. 2. We can invest in 8 companies ranging from a variety of fields classified as diversification, where I will touch on later. This can be of tech, health, energy, consumer, financial, industrial, utilities, and real estate, all chosen randomly for each trial. 3. We will have $1,000 to invest in each company, which we will be using fractional shares, where you buy fractions of a company's stock, then whole shares. This will ensure there are no unfair advantage is placed for each stock. And finally, there will be a buy and sell time frame, where we would buy at April 1st, 2024 and sell on October 1st, 2024. A quick note though, it would definitely be more realistic to choose a current date for this experiment being around April 2025, but due to the tariff wars occurring, the stock market alone is facing an unpredictable downward trend and would make this experiment void or unreliable. Where we will be getting our stock price statistics is Yahoo Finance, and it's basically a website that tracks live and historical data of company stock, and also has an array of other tools for investors, like having financial news and commentary analysis. And for the most crucial part of this experiment, where I will be organizing and experimenting this data, I will be using Google Sheets, where I will be allowed to make my stock investing portfolio replica and be allowed to make comparisons between each investment strategy. Now, with all the conditions set in place, without further ado, let's begin our experiment.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, money, money.
Dollar, dollar. Dollar, dollar.
Okay, so for our first part of the investing experiment, we're actually going to be doing like a joint kind of trial here. So basically, we're going to be running two investing techniques at the same time because they're kind of interconnected with each other. And this would be diversification and buy and hold. First, I'm going to run their definitions real quick. We obviously want to know what they're all about. And then I'll go through the Google Sheets of how I ran this experiment, how I gathered the data, and I calculated them to make observations and such. But first, what is diversification all about? So diversification is the spreading of your investments both among and within different asset classes. What I mean by that is you're basically buying an assortment of different companies that you're interested in. This could be from different ranges of industries that the company is from that I listed or I said before in the conditions. And here it could be like from technology, health, energy, consumer, etc. And that basically creates the chance that if one of the company stocks that you invested in is falling or failing, another could be there to back it up because it's in another industry. And an example could be like here, Pepsi, since it has a negative 2% return rate, and mind you that return percent is how much you gain back from your investment. Here, you actually lose 2% of your investment. You have all these other companies that you invested in, and they can back up this loss with their own success in raising your investment. And buy and hold is a long-term strategy where investors, they pretty much hold their assets that they purchased for an extended period amount of time. This could be for a month, 3 months, or in this experiment's case, about 6 months. And this is to basically ensure that your investment grows properly, that you don't just sell it as soon as you see the first rise of your investment. So, and a lot can happen within 6 months. So now moving on to the Google Sheets, I organized it where on the left here, this is where your company info or the costs of your company stocks would be worth. Here in this column, this would be on the buy date of April 1st, 2024, how much it's cost on that date. And then here is the selling date where how much it would be worth on the day of October 1st, 2024. So 6 months after this. And here more towards the right, this is where we get more into the calculative stuff. So here, this is where you buy, this is how much you have invested in each of these stocks. So again, here is the fractional shares that I have been talking about before. And then here, this is where you determine how much you basically earn back, how much you earn back or you lost. So just looking at it from observational wise, we can see that maybe one of the highest return percentages that a company can give us is about 30%. As you can see, 34%, 33%. That's pretty much the high trend going on for a 6-month investing period. And then the lowest we can clearly see is about -%. Some of them get even lower to as -18% that the company ConocoPhillips has. I also calculated the average return percentage. So basically the average return percentage is how much all of these return percentages of these entire portfolios has earned you in general. Our highest here can be about 13%, so just above 10%, which is actually not genuinely bad, especially if you're investing in an assortment of companies that can definitely earn you some money, while the lowest is about 7%. Visually, you could definitely see there's not too much of a harm in doing diversification and buy and hold, because you can clearly see there hasn't been any loss in return percentages. Because when you're investing in all these companies, most of them are bound to pretty much rise in costs or grow as a company. Therefore, the prices of their stocks are rising and your investments are being more valuable. So as you can see, there's not really any harm. If anything, the worst case in this scenario would probably be you not gain as much money as you wanted to, but in the best scenario, you're not losing any profit. Okay, so moving on to our next part of the investing experiment, we're going to be going over the 7% rule. And this is basically how it sounds like. It suggests where you exit a position if the stock price falls below 7% below the purchase price. It's basically whatever price you buy your company at. Say, for example, Apple, you buy it at $170.30, and 7% below that is about $158. If during the 6 months that you invest, you leave your company and it falls below $158, the cost of your price, then that's when you choose to sell it and you don't stick with it. That is with the intention to reduce risk, obviously, because what this technique looks for is it reduces the chance that whatever stocks that you buy, it drops even below more than 7%, making you lose more money than you have to. And depending on the portfolios of investors, people would want to use this because it's very safe as you don't lose a ton of money. But looking at my Google Sheets here in my experiment, one thing I did notice was a lot of the companies did fall below 7%. The most companies in each trial that didn't and sticked with were about 3 max, which is 3 out of 8, below half of all of the stocks that you invested in your portfolio. So here you can clearly see there's 3 of them were above the 7% rule, never fell below. Only one of them, in extreme cases, just only one of the company did not fall below the 7% line. So you're basically losing out on all of these other companies that potentially could have regained your return percentage and went back to the normal buy price and maybe even more further than that. For example, here for American Tower, it did drop below 7% at not even like the first 2 weeks of investing in this company, and it's already dropped 7% or 8% in this case. But if you had choose to stick with this company, then you would have got about 18% return percentage at the end of your 6 months. But because it fell below 7% and you were following the rule, you missed out on this return percentage or this gain that you potentially could have got. This technique is all right in a way, depending on your intentions or not. Like if you want to make a big return back and you don't really look for having a stock to be stable, then 7% rule might not be for you. But if you want to not lose money, a substantial amount of money in any of your stocks, then this probably would be the most safest option for you or route. Looking at it visually, you can clearly see the average return percentages. The lowest was about -2%. Yes, you can lose money from the 7% rule, but it's not as much as you would lose if you were investing blindly, like without any technique or any news of some sort, without any information. But you can clearly see here, it either increases or it decreases within only about 3%. So you're pretty safe in that line, but the only loss is you're not gaining as much money than you would hope to, like how in diversification you can earn a return percentage of over 10%. But here you're kind of stuck in that 3% range within a 6-month period. You would have to keep that in mind. Okay, so for our next investing experiment part, we're going to be covering the dollar cost averaging rule, and this compared to diversification, buy and hold, and 7% rule is a little bit more complicated to go by because you have to do more in general. But basically, it's where it is the practice of investing a fixed amount of money at regular intervals, regardless of market conditions. So what you would basically do is, for example, on the first month or when you first would buy the stocks, you would not pay your overall amount of $1,000. You would first start off with a partial or a part of it, like $250 in this case. So you would first invest $250, which obviously is not going to gain you a lot, just considering that it's a fourth of $1,000 here, and that whatever gain you get later on, it's not going to give you as much as a return percentage. But after another month, you would add another $250, and then you would have each month you would add $250 until it reaches 1,000, and from there it pretty much averages out, which is, becomes the term averaging. And when it averages out, that's when it meets up to the best potential average return percentage possible, and this can be like 13% in this case. Which is I think I also observed the same as the diversification. See, in this part it's also 13% too, but the only difference is that you share a safety net where, if something were to occur, like a natural disaster or a tariff, and that ultimately crumbles whatever company that you invested in, and it falls off like entirely, then you would save money because, well, for example, if something were to happen to Apple, it completely falls off in the second month of you investing in, you still have saved up $500 because you haven't invested in that. But if you were to do this in the case of diversification or buy and hold, where you put all $1,000 already, then you're already losing pretty much your whole investment. So another thing that can also be different from diversification and buy and hold is here, for the stock prices, every time you invest the $250, the stock price could be lower or it could be higher, and you're basically earning more or less money. So it's basically giving you more opportunities if you would want to your stock price to be worth even more or less. For example, here you can see that when you put $250, it actually rose $20 more than the initial price of how much it was worth. But then here it was only $169, so $1 off. But obviously there's not too much of a difference from that. I mean, obviously comparing to the 7% rule, it's definitely different and it's not the same in results wise. But for diversification and buy and hold, the end result is definitely the same. The only way it's different is how more safe it is and what you'd have to do and the amount of effort that you would have to take. So again, depending on what your intentions is with investing in stocks, if you want to be very invested in your stocks and track it from time to time, dollar cost averaging rule is definitely the way to go. But if you are busy, don't want to do much, you just want to let it do its own thing, then diversification, buy and hold is your other second option that you would probably consider more. All right, so for our last stock investing technique, we will be going over the artificial intelligence assisted investing, which if you don't know, is basically like a supercomputer that impersonates or acts like a human. It can give human responses and such. The software I'll be using today for this experiment would be ChatGPT, and ChatGPT would be an expert in basically anything. You ask it questions, it'll answer you right back as if it was an expert on them. So what I did is I asked ChatGPT to, under the conditions that I stated for this experiment, to basically make an investing portfolio for me and have that done in 5 trials. All this charts, these calculations and such, I did not do them. This is all from ChatGPT. So, and basically how it does this is it also, not only being an expert in investing in all this and all, it also tracks lifetime market information like stock prices, financials, analyst ratings, to news headlines, to even like social sentiments. So like maybe they would go analyze Twitter and see which stock is being the most popular amongst people or demographics and such. And it could also do things that not a lot of us investors can find easy to do. It can also recognize patterns, like maybe it can recognize a stock with stronger earnings and low debt that tend to outperform in high interest rate environments. So it can do a lot of that abilities and such. Looking at this, it's looking pretty good. As for the return percentages, a lot of these they do not lose money at all. The lowest percentage is about 3%, and the highest is about 7 or 8%. So it's really not that bad. And looking at this visually, this has a return percentage of over 4% and about 6 or 7%. So again, this is under the same conditions that all the other investing techniques that we've done is under, and you can see it's actually not bad comparing to 7% rule, obviously, which you lose a little bit of money, but in this case you actually gain a little bit of money, and you don't really do anything at all. You just let AI tell you which ones are the most reliable, or which ones are the most worthy of being invested in, which one seems the most return percentage worthy. The calculations that ChatGPT here did, you can see they've picked a variety of stocks that you can obviously know that they picked off based off the information that they got from real-time market. From the return percentages, you can see that the max is about 8%. Their highest return percentage is about 8% in a company. And the lowest is about 3%. None of the companies seem like they really went below the return percentage and a negative or made you lose any money at all. But if we were to go to the average return percentage, the highest is about 6% and the lowest is about 4%, which adds to a total of up to a 5% average return rate, which is really not bad. I mean, compared to the other investments, we can clearly see, for example, diversification, it's double, like 10%, 13%, while down here it is, well, the AI investing is just about 5%, which again is not bad. 6%, not bad, but obviously if you would want to have more money, then this would not be the greatest choice. But if you want to just make a little money at the side, then AI is okay for that, especially if you just really do not want to try out this investing thing at all. Then AI has got you, since it can basically do everything for you without you having to make effort in learning or making investment amends. All right, so as we wrap up this experiment, we're going to be making some quick comparisons real quick between the different investing experiment techniques that we have covered so far. And just looking over here, one observation I can clearly see is that the diversification and buy and hold can definitely compare with the dollar cost averaging rule. There's not too much of a difference, except the dollar cost averaging rule does seem to get more numbers in than the diversification and buy and hold. And there's also that safety net where if anything happens to the market, like a market fall off of your company, then you still have the chance to save some of that money. The worst out of all the performances is the 7% rule. Obviously, it's not the worst or the worst of the worst, as it like costed you so much money, but you can definitely see that you lose some money in some of these trials compared to all the other trials where they did not lose any money at all. AI assisted investing actually did not do that bad. I was actually surprised that it did less than the dollar cost averaging rule and diversification, because I thought that if it were to work more on logistics of the market and the stock prices and all that, it would calculate enough to make a better average return percentage than versus dollar cost averaging rule and diversification and 7% rule, where those you would just have to rely on chance or you're basically gambling whether your investment that you choose goes up or not. But then it's covered again within how these techniques work and the methods they utilize to cover those chances. Now, if we were to look at it on a graph here, we can clearly see again, diversification, buy and hold, and dollar cost averaging rule, they're pretty much neck and neck. 7% rule is the worst. AI assisted investing is in the middle. So for utilizing these techniques without having any marketing experience or tracking the market of any kind from your behalf is actually not bad. You can clearly see that all of these do not result in a tremendous loss or negative return percentage, and as an investor that has no knowledge at all. Now, despite the head-to-head or neck-to-neck of diversification, buy and hold, and dollar cost averaging rule, I'd probably say the dollar cost averaging rule is probably the best technique here in trying to make the most money in long term, and long term as in like 6 months period of this experiment. So with dollar cost averaging rule, not only do you have the chance to build more money, but you also have that safety net. If anything happens to your investment, then you can easily stop putting more money into that investment than versus the diversification where you already like invested all your money into it, where you cannot remove them or not. If you ever consider to invest without having any experience at a young age like me, and you don't have the time to really devote yourself to the stock investing experience, then this is most likely the best way to do it, despite it more leaning towards more chance or kind of a gamble than versus, you know, other investors who look at real market data, real time statistics, and use and things that might affect the stock market. But then again, we all have our own intentions. But at the end of the day, it's just to make money and profit off this stock investment. So I hope you enjoyed this experiment and this study I have conducted here. I hope you learned something and got something out of this. Obviously, again, this is not my intention to get you into investing, but if you have to ever consider, maybe you can look back into this and consider these type of techniques and whatever trade-off they might have. But for me, I would definitely utilize this information, as I would love to get into investing later in life, or even right now, considering that it's never too early to start investing and get that financial benefit for the long run. But again, thank you so much for watching, and I hope you enjoyed this video. I hope to conduct future researches maybe of this stock investing experiment, maybe in a more realistic scenario where I get to be able to use current stock statistics. But as of now, I think I'm gonna take a break because this was definitely kind of a hard experiment to do, considering how much data collecting time you had to do and how much research was going into this, as me not knowing anything about investing. But I loved how I got to be able to learn and gain information about investing into stocks, as this is something definitely that I want to do later in my life. But that's pretty much it. Thank you so much for watching, and hopefully we get to see each other again. Peace.